Hey friends, welcome back to the channel. I'm Iggy, your guide to all things finance, investing, and wealth building. If you're new here, the Investing Iguana has been ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. Thanks to your support, we've produced over 650 videos and racked up more than 300,000 watch hours as of December 2024. Today, we're diving into a topic that's got many investors talking: JPMorgan's recent downgrade of Mapletree Industrial Trust, Mint. What does this mean for you? Should you be worried or see this as an opportunity? Let's break it down together. Let's start with the big headline. JPMorgan has downgraded Mint from overweight to underweight. Now, if you're wondering what that means in plain English, think of it like this. They've gone from saying, "This stock is a must-have," to "you might want to lighten your load." And that's not all. They've also slashed Mint's price target from SGD2.50 to SGD1.90. That's a pretty sharp drop. But why such a drastic move? Let me explain. The main issue here revolves around Mint's distribution per unit, or DPU, outlook. For those of you new to RATs, DPU is essentially the income you get from holding units in the trust. It's like your paycheck as an investor. JPMorgan is forecasting a yearly decline of about 4% in DPU over the next 2 years. And let's be honest, no one likes a pay cut. So what's causing this drop? Two big factors are at play here. First, JPMorgan expects higher vacancies in Mint's data centers in the US and Singapore. These properties contribute about 5 to 6% of Mint's revenue, so even small changes can have a big impact on the bottom line. Second, some of Mint's US data centers are aging and smaller in scale. Investors are worried these properties might become obsolete, kind of like owning an old smartphone that struggles to keep up with new apps. Now here's where it gets interesting. Despite these concerns about the future, Mint has actually been performing well recently. Over the past 3 quarters, it beat earnings estimates, a great sign for any company or trust. Plus, its DPU has stayed stable for the first 9 months of FY 2025. So why isn't JPMorgan impressed? Well, they believe these positive results are being overshadowed by bigger risks ahead. Let me put it this way. Imagine you're driving a car that's running smoothly now, but has warning lights flashing on the dashboard. Sure, it feels fine today, but what about tomorrow? That's essentially how JPMorgan sees Mint right now. Let's take a closer look at why analysts were optimistic about Mint before this downgrade. Earlier predictions had expected its DPU to recover in FY 2026 thanks to 2 key factors: positive rental reversions and recent acquisitions in Japan. Positive rental reversions mean higher rents when leases are renewed, kind of like getting a raise at work when your contract is extended. And those Japanese acquisitions were supposed to add fresh income streams to Mint's portfolio. But here's the catch. JPMorgan no longer thinks these factors will be enough to offset the challenges ahead. They've revised their expectations downward because they see more headwinds than tailwinds right now. So what does all this mean for investors? Let me break it down into 3 key takeaways. First, this downgrade signals caution for Mint's short-term performance. If you're looking for stability or growth in your investments right now, this might give you pause. Second, obsolescence risks are becoming a bigger concern, especially for those aging US data centers we talked about earlier. Think of it like owning rental properties that need constant upgrades just to stay competitive. And third, there's a risk of further derating if these issues aren't addressed effectively. In plain English, that means analysts and investors could lower their expectations even more if things don't improve soon. Now, let me share some practical steps you can take if you're holding Mint shares or thinking about investing. First up, do your homework. Take a closer look at Mint's portfolio and financials. Are there signs that management is actively addressing these concerns? For example, are they upgrading those older data centers or finding ways to reduce vacancies? Next, diversify your portfolio. Don't put all your eggs in one basket, especially if that basket has cracks forming. Consider spreading your investments across other REITs or sectors to balance out your risk. And finally, stay updated. Keep an eye on future announcements from Mint and other analysts' reports. The situation could change quickly depending on how management responds to these challenges. So what do I think about JPMorgan's downgrade? Personally, I see it as a reminder that even strong performers can face challenges. And as investors, it's crucial to stay flexible and adapt our strategies to changing conditions. All right, friends, that wraps up today's breakdown on Mapletree Industrial Trust. If you found this video helpful, don't forget to hit that like button and subscribe for more insights like this. And if you're looking for more REIT content, check out my recent video on Singapore REIT's crash biggest buy since 2020. It's a deep dive into whether now is the time to seize major opportunities in the REIT market. Trust me, you don't want to miss it. Until next time, stay curious and keep investing wisely.